G'day guys, I hope you are having a great week. This video is to discuss something that I think needs to be discussed. It's about slippage. Now, as you know, FTX is the place where I do pretty much all of my trading, to be fair, apart from anything that's spot against Bitcoin. And you know that, obviously a lot of you are using FTX as well, because that's who I recommend to use. It's got the best order systems that I can find, and it's, I know the guys and they're good. So it ticks all my boxes. I'm very happy with what's going on with them so far and how they've been treating the community and me. It's been really good. So one of the things that I want to discuss with you is, slippage, because I see that people sometimes shy away from taking their trades, and you shouldn't be shying away. It's not the platform's fault. I know a lot of you have got accounts open, and I know a lot of you are not trading on those accounts. And I want to find out, and look, please, I'm always open to feedback. Like if there's something that's happened, or if there's an issue, or if there's something that you want or want explaining, just let me know. Don't forget that what you might see is something that you can't work out quickly. I could probably just do it in a 30-second video, or in a 30-second chunk of a video, and explain it to you real quick. It's a great platform. You should be using it if you're trading. And if you're not, and you've got issues, just let me know. I'll work it out for you. All right? Bottom line is this: slippage. Now, for those of you who have been through the gambit of all my courses and have the Crypto Cradle, the Bitcoin Breakout, and the Fibonacci Booster, and understand what optimal chart structure is, you'll know that the part that, I when people say, do you use volume? I say, no, I don't use volume. But I do look at the charts to find out where that, what's got liquidity and what hasn't. Now, I scanned this list. And if you would like this list and you haven't currently got this perpetual list for FTX, just reply back to admin@tradercobb. I think it's just coming from here anyway. admin@tradercobb.com. And I'll get you this list. It's already set up. Just go and blow your socks off, all right? It's all there for you. So what I want to do is I want to take you down to the 15-minute time frame here. Now, for there to be an order filled, you need to have a buyer and you need to have a seller. They need to come together. And the way I explain it is this: if I go to the market and I've got 6 tons of bananas in the back of my truck, all right, 6 tons of bananas. I come in and I go, hey, look, I want to sell 6 tons of bananas today. Well, then I better hope there's a lot of monkeys around. But I need to sell 6 tons of bananas. So one of two things needs to happen. There needs to be a lot of people that want to buy bananas if I'm going to sell them. And I need to create a market where the price is going to be met. But there's got to be the market. It's simple supply and demand. Now, if I sell 300 kilograms of bananas, it doesn't mean that I'm going to be able to sell the other 5.7 ton just because I want to. That is a mismatch of supply and demand. Obviously, the demand is just not there for those bananas. So I'm either going to have to get rid of those bananas, let them go off a little bit, and take lower prices. And that's what slippage is. You might go, look, I don't really want any bananas. But then someone goes, look, it's 10 cents for a kilogram. I'll go, well, okay, I'll take those bananas and I'll buy them, like 10 cents for a bag of bananas. I'm happy with that. That's a bargain, right? So I'm happy to do that because I've been enticed to do that. Now, there might have been $3 a kilo at the start. Now it's at 10 cents a kilo. That is slippage. That is the supply is high, the demand is low, so the price needs to meet that. Now, bear with me. When I look at how do I relate it to a chart is what I'm going to get to now. Well, if I look at Bitcoin right here, you can see, and this is how I do it. I do it with the Bitcoin chart and then the chart that I'm looking at. If I look at the 15, you'll note here that there are no real places where there's any gaps or flat spots. And let me show you what that means. So just take a mental snapshot of this chart, and then let's have a look at, say, Leo. So see how Bitcoin here, it's a smooth flowing chart. We don't have too many black spots, too many gappy spots. The chart, it trends, it opens and closes. The candles open and close at roughly the same sort of points. You go to something that looks like this, and I can tell you this is a 15-minute time frame. See these little spots like that? That means no trading at all really happened at that level, or very little for that matter. So the way that I teach people how to trade is to avoid this sort of a chart based on what I call optimal chart structure. So that's how we can read the chart to understand whether there is liquidity or not. But there's also this. So across here on our FTX platform, obviously I've got Bitcoin here. You've got your market trades. This is the trades that it went through. Now I know a lot of people put a lot of emphasis on the order book. I am not one of those people that spends too much time on the order book. I look at the market trades because an order book can be manipulated. I can put fake orders in there. I can do whatever I want. It doesn't, just because an order goes in doesn't necessarily mean it's going to go from the order book side into the actual executed trade sides. And this is when you'll see these people calling, oh, it's a massive buy wall, or like in this case, they call that a sell wall. So what? It doesn't mean the price is going to go lower. It doesn't mean the price is going to go higher. It just shows what's on the books. I'm interested in what is over here in the actual trade. So the size of the trades going through, they show it on FTX in US dollars. Okay, so we know that. Now, let's do a comparison. Let's go and have a look at one of these newer contracts that will probably not have a great deal of volume yet because it is newer. Again, here we are. Look at this. The bid and the ask, look at the difference. See how there's a bigger differential in price. If I flip back to Bitcoin just quickly, okay, in the perpetual, because that's where I trade, you'll note, look, 799.5, you got 50 cents because there's a lot going on in this market. It is a highly liquid market. The most liquid of the markets that we have on a consistent basis has to be Bitcoin. Now we come over here to this one, BRZ Perp, and you can see there really isn't much going on at the moment. And like I say, the reason I chose this is because it's a very new, fresh contract, and it takes time for volume to come through. Look at the difference. It's not exactly one sat or whatever you want to call it. There's a lot less there. Also look at the size on the order books. It's very, very, very illiquid. Now, if I'm going to go in here and I'm going to say, put a limit order in here, and let's say I want, that 50,000 contracts here. Now I look at the amount in US dollars, 9,669. Well, there's nothing even close on the order book, and there is nothing close that's actually gone through around that size. So with a very quick little check, I can go, oh, I can see that there might be some issues there. Now, I don't need to go down through this order book to calculate how long it would take me to fill that trade. I really don't care, because for me as a trader, I've got an entry and a stop loss and usually a target in mind, and I want them to be filled at the most precise level to that area. If you're going to trade these illiquid contracts, you are going to see more slippage. Let me come back over to here, because there's not a buyer and a seller meeting at the same level you want, and if you're putting a market order in there, it's going to work its way up or down through those books to fill that trade for you. Coming back to Bitcoin, let's say we do the same thing. Let's say roughly the same amount. Is there enough going through? Is there enough on the books? Look at the dollars. Plenty, right? Plenty. And is there enough going through here? Yep, plenty. There is enough going on there. I know I can take this trade without getting too much or any slippage. There shouldn't really be too much slippage on something like this in a small position like that. Now, that's how you can check. When you do your risk management in your calculator over here, that is how you can check if you are likely to cop too much slippage. There's also another way. I'll take you back over here. If you have been experiencing a little bit of slippage, then what you want to do is you want to ask yourself, what time frames am I trading? You're likely to see a lot more slippage if you're trading really low time frames. So right here, the example is the 15 minute. Now, here's the reason. Let's say I want to risk, actually, let me show it to you like this. Let me go back to FTX. Let's look at this and say, I want to risk $1,000 on the trade. I'm going to go for a limit order, a limit buy. I'm just going to go 95 because it's miles away, and I want to risk 1,000. So I'm just going to come into here. I'm going to go limit. I want to say 95, didn't I? And this is this is perfect. Like it's the best little setup here. And I want to stop loss at, I don't know, 93. Now, so you can see with one contract or one Bitcoin here on the contract, $200. I want to risk 1,000, so I'll go 5. And there we go. I have a $200 stop. I'm risking $1,000 here. That's a $1,000 risk with a $200 stop, which means that it's not a very big position. Now let me show it to you if I was to go for a much tighter stop and show you how it would differ. So let's say I'm going to go 94.50. So now I'm trading on, say, the 15-minute time frame where there is a really, really tight stop, just $50. Notice how all of a sudden my position is, with 5 contracts, it's only $250. So now I need to go to 20 for the same 1,000. So my position is going to be far greater if I'm risk managing my account properly. The smaller or the tighter the stop loss is going to be. Now that might seem like simple logic for you, and it might be. You might have been trading for a little while, but that's how you get slippage. If you go low, and look, I'm not saying don't trade low timeframes. Not at all. I trade low timeframes as well. I'm saying be aware, because now I've got a $190,000 US dollar position as opposed to what the other one was of what was it, the 50,000 or whatever it was. So big difference there. If you're going to trade the lower time frames, trade the contracts that have the best volume. Trade the to your account as well. So if you've got a larger account, stick with your Bitcoins, your Ethereums, XRPs, Cardanos, that sort of thing. Go where the volume is. Go where the volume is. Liquidity is king if you want to avoid slippage. So now if I get a $50 slippage here, like a big spike, I've just lost $2,000 to slippage because the market moved too quick, didn't take out my order, and because I've got 20 contracts, $50 is the exact same amount of my trade risk on this. If I lost $50 of slippage on a $200 stop, well, of course, it's only 25% of the overall position. Now, if you're sitting there going, that sounds quite complicated, then watch this video again, because it's not complicated. Okay, maybe I've described it pretty complicated, but I usually make it quite straightforward as much as I possibly can. Slippage, to wrap it up, if you don't want to cop slippage, don't trade the really illiquid contracts. It's that simple. Okay, it's that simple. If you've got a smaller account, well, then you can trade lower timeframes on lots of different contracts because your position sizes won't be all that large. What you've got to do, and we teach it in the course, is you've got to find the sweet spot for you, and it will take some time, but that's okay. If you're trading 500 US per trade, 1,000 or more, you're probably best off sticking, if you're going to trade the lower timeframes, on the top 10 at an absolute minimum. Take the time to learn your platform. Take the time to know what you're looking at, and it will serve you well, and you won't get freaked out when you do get some slippage, or you won't get it at all because you're managing your portfolio the way it's meant to be managed. Do I get slippage? Yeah, sometimes I do. Does it bother me? No, it doesn't, because I know how to manage my portfolio, and it's a part of being a trader. I'd get it in other markets as well. It's not strictly there for crypto only. So get back into your FTX account and get going. And if you have any questions, please do ask, because I'm here to help you. Guys, I hope that was beneficial. I know it's a bit longer than normal, but it's there to guide you and to give you an understanding of what slippage actually is, because there's a lot of questions out there. Simply supply and demand. Have a great day. Speak to you soon. If you haven't got your FTX account, well, there's a link below here. So go and get it. You get 10% off your trading fees going forward. Take care. Bye for now.
The Trader Cobb Crypto Show, talking business in blockchain.